Good evening, everyone, and welcome to UTI Mutual Fund's Fixed Income Market Insight webinar. The fixed income landscape today presents an interesting mix of global and domestic factors. While geopolitical developments continue to evolve, softer commodity prices and improving manufacturing activity have influenced the global growth and inflation outlook. Domestically, inflation, liquidity, external sectoral developments, and the monsoon remains the key factors shaping the outlook. Against this backdrop, RBI's latest policy and its assessment of growth and inflation provide an important lens for the road ahead. Global bond markets developments will remain an important factor for India's fixed income markets. In today's session, we will begin with the global macro landscape before turning to the domestic outlook, including the RBI's policy, inflation, liquidity, and trade deficit, and their implication for the fixed income markets. I am Sandeep Solanki, product specialist, and I'm joined by our head of fixed income, Mr. Anurag Mittal. With that, let me hand it over to Anurag. Anurag, over to you.
Thanks, Sandeep, and good day to everyone. While July was a very headline-inducing month and continuing into the early part of August, of developments happened. We had the re-escalation of Iran war. We had the US FOMC policy, which was quite notable. And the first week of August, we had the RBI policy. It's important to go beyond the headline and to really see what mattered for fixed income market, what's more durable, and what really matters for our portfolio strategy. So we'll try to deep dive into the main issues which are facing the market today and what's really we see are more everlasting impact on the bond market. So we'll start with the global trends. So broadly, we are continuing to see expansion in both manufacturing and services PMI. And one interesting trend which we observed, especially compared to last 2 months, is that now Europe, especially Germany, has started to recover. US, of course, continues to remain quite strong. And we have now China, which is slowing down because while the export model for China is working very strongly, unfortunately, the unemployment and the demographic disadvantage that China has today in terms of slowing population is leading to slowdown in consumption. So while export, if you look at really China's exports, it's very, very capital intensive. That is, it requires less labor. But if you look at the domestic consumption factors, whether it's real estate spending, whether it's employment generation, that continues to slow down. In fact, their Q2 or Q1 GDP growth was even lower than their forecast, and same trend that we saw in the concurrent indicators last month as well. So broadly, if you look at manufacturing, despite the Iran war, we are continuing to see strong order growth in both US and in Europe, especially Germany, while China remains moderate. If you look at services, we had the World Cup, due to which we saw one-off boost in consumption and tourism, which benefited both Europe and US broadly. We need to see how much of this sustains beyond July. So we really need to see how services continue beyond this one-off event. And like I said, there's a divergence. If you look at the economic activity surprise index, while Europe has started to recover, but nevertheless, it remains quite moderate compared to US, which is seeing the benefit of massive investment due to AI-related capital expenditure. And China, like I said, where it started to slow down because of lower domestic consumption. If you look at oil, and we saw first in June, we saw de-escalation of Iran-US conflict, and in July we saw again the MOU breaking down, and again attacks started in the Middle East, which led to again some volatility in oil price. But ignoring all the headlines, let's look at where oil inventories are. So even if the war were to end today, how oil prices could remain affected. So this is the total US commercial inventory, which includes the US Strategic Petroleum Reserve, as well as commercial inventory held by private corporations. And if you see, the US oil inventories today have fallen about 26% below, average, and it's almost at its 5-year low. While this chart, only for ease of simplicity, we have kept the chart a little shorter, but broadly, US inventories have gone down materially. And if you look at and compare to the 2022 shock, during this time similar after the Russia-Ukraine episode, it took about 13 months of oil release from the strategic reserves to see this kind of fall in inventory. If you look at today, the same fall has happened in 6 months. That means the what we saw in oil prices, because everyone was concerned that if Hormuz remains closed, oil prices should really shoot up. And this is one of the big reasons why oil prices did not shoot up despite Strait of Hormuz closure, was US was depleting its oil reserves. So even when the Strait of Hormuz opens up, while we do expect probably in first couple of months that market will try to balance and we will not see major uptick in oil inventory, but ultimately this oil inventory will have to be refilled. So that's why probably we should not expect oil prices to remain extremely low for a long period of time. It will be interesting to see at what price point does US come back and refill its inventory, or it continues to run down and let its oil inventory remain low. Of course, if oil inventory continues to remain low, that means lower oil prices can continue for longer, and that's the interplay that also will have to be seen when Strait of Hormuz opens. Looking at commodities, of course, we talked about oil, and again we saw Bloomberg Commodity Index rising by 7% month on month, led by energy, where we saw oil prices again crossing $80 because of, again, re-escalation of US and Iran conflict. We also saw some uptick in prices in industrial metals like iron ore and copper due to tighter supply. So that's also we continue to see. So while overall, I would say index is still quite managed, we are not seeing any pickup in food prices. For example, if you see the chart on the right-hand side, food inflation remains quite benign on a year-on-year basis, despite recent increases in cereals, sugar, and vegetables, oils. We are seeing weather-related shocks in key weather-producing regions, whether it's Europe, it's US, or Latin America, of course, apart from India. So while we are seeing some pickup in food prices, on a year-on-year basis, they continue to remain quite moderate. But that's something which we have to watch out for, whether this commodity inflation led by oil continues if the recent escalation remains, or whether it starts to subside. And that's something which, of course, every central bank and every market participant is watching, but that's something which you really can't put a lid on, that saying that, okay, inflation has subsided and there is no impact. That's something which can suddenly, given the volatility of commodity inflation and the ultimate pass through on various manufactured goods as well, this is something which we have to watch out for. So it's difficult to really price out any major inflation risk. So one aspect which really just wanted to update, of course, which has been out of sight and out of mind for most market participants, which is US tariffs. So after being at the forefront of all economic commentary in last calendar year, we saw last year Supreme Court putting a stay on tariffs. So as a workaround, the US administration had put a Section 122 surcharge on all imports in the US, which broadly led to 10% tariffs everywhere. And that broadly, and given the various exemptions given to some most favored countries, the overall effective tariff rate was coming out to be 7%, which was still lower than the Liberation Day tariffs. Of course, that Section 122 tariffs can only run for a certain day. So after after 150 days coming over, the US has now put the new tariffs under Section 301, which basically preserves the broad framework. So after setting of the, like I said, most favored nation status, some product specific inclusions given by the president, broadly, we are looking at effective tariff burden of about 8% for the US. So compared to 7%, it's not nothing material. 8% largely, it's about continuity of the tariffs. So tariffs are not going back to zero. I think that's something which the US administration is quite serious about. So despite adverse court orders, they are trying to ensure at some level of tariffs continue. If you look at, for example, for India, earlier under the reciprocal tariff rate regime, India had an 18% tariff. Now under the new Section 301 tariff regime, India will be subjected to 10%. If you look at Europe, same 15% goes to 10%. So for many economies, this current tariff workaround is actually quite positive compared to the earlier tariff regime. Of course, US is further investigating into various countries whether they are breaching various environmental or child labor guidelines. So if US feels, depending of course on the course of investigation, they can put higher tariffs. They are already doing undergoing negotiation with India, for example, on a reciprocal trade deal. So we really need to see how this evolves. But broadly, the tariff situation is still there. We continue to expect that tariffs will remain as part of the US economic policy for foreseeable future. We had the FOMC meeting last month where FOMC held rates between 3.5 to 375, but interestingly, three Fed members voted for a 25 basis hike in this FOMC policy, signaling incrementally hawkish shift in the Federal Reserve policy debate. Of course, while the statement did not give too much clarity, market participants were waiting for the press conference by the new Fed chair, Kevin Warsh, to get further clarity on what were the Fed expectations on the inflationary front. And of course, the press conference was slightly different to what market participants and media is used to, where the new chair did not give too much clarity on Fed reaction function, which was intentional because that's something the Fed has been doing under the new chair, where they are against forward guidance. They want market to make up its own mind, to make up its own projection, and really try to forecast Federal Reserve reaction rather than Federal Reserve spoon feeding the market on what it attempts to do. So while market took the policy as hawkish, as well as the press conference probably thinking that the takeaway from the press conference was probably Fed chair is not as serious about inflation as they were purporting to be. So for example, if you look at the Fed chair's recent testimony to the Senate Banking Committee in July, in which one of the statements that the Fed chair made was inflation is a choice, which basically meant that they are not looking at supply side aspect of the inflation. As long as inflation is high, it's a choice of the central bank to keep rates low, which broadly meant in a way to the market that the central bank is quite serious about inflation, whatever the sources or drivers of inflation, whether it's a supply side led or a demand side led, and probably they will take action. So when they came to the press conference or to the policy, the Fed is planning to wait for future action, future data points to really take a call. So the difference between the previous Fed and the current Fed, as per at least our assessment, is, of course, things are always uncertain. And if we see post-COVID, whether it was COVID, whether it was Russia-Ukraine war or other supply side shocks, Fed was always grappling with uncertainty. But within that uncertainty, Fed under Chair Powell had tried to give a rule or their reaction function, that how they will act under certain assumptions, which was quite comforting to the market. The current Fed chair, or the current Fed, in which it's moving back to the Greenspan times, in fact, we have written and talked about it, is that they want further clarity on data. They want continuity on a certain trajectory of data before taking any action. It doesn't mean whether they are hawkish or dovish. It just means that they want to be certain of the data before taking any action. So while The economic environment is always uncertain. That's any central bank which is facing any economic environment has to face that uncertainty before taking any decision. But the difference between the current Fed and the previous Fed was the previous Fed was afraid of inflation overshooting its target, and they would err on the side of caution. They talked about it. They said that the risk of inflation is asymmetric, so we will prefer to act even if we act slightly prematurely to ensure that inflation stays within its target. And if you compare to the current Fed, they want to look at broad set of indicators and broad data points before taking any action. What we also mentioned in the last webinar was that Fed has set up 5 committees to look at inflation, to look at productivity, to look at forward guidance, etc., etc. And they are also probably awaiting the recommendations of those committee before taking any action. So the deadline for all those committees to present their finding is by December. So we do expect that probably Fed will wait till December to take any action. By that time, probably inflation, because of the base effect and also because of AI related productivity gains, we do expect inflation to start to slow down from the current level. So probably by December, Fed may not even need to hike materially going ahead. So that's one difference of opinion we have compared to the consensus expectations. We don't think Fed is hawkish or dovish. Fed is just planning to wait for more data and more certainty before taking any action. The current Fed is not planning to give too much of forward guidance, and it want to preserve policy independence rather than giving market any framework which they can't hold to. So that's something which the current Fed is planning to do, but we don't think Fed policy should be taken either ways. They will want to wait for 3-4 months of continuous inflation above their expectations to really take a call on interest rates. So that's something which we think where market could get positively surprised that probably by December, economic data will continue to show slightly softer inflation and softer job growth going ahead, which means a less aggressive Fed rate hike path compared to what market is currently estimating. On the ECB, largely it was in expected lines. While they had hiked 25 basis in June, they kept their interest rate stable in July as they assess the evolving inflation outlook. Of course, for them, energy, both on oil and natural gas, continues to be an upside risk. What they want to do right now is while they don't mind hiking, they want to really await more data. They want to assess the second order impact of higher oil prices on the economy before taking any rate action. Market is pricing a couple of rate hikes in next 1 year. We think that's quite doable and quite possible. Overall, they are quite symmetric about their reaction function. So they are quite clear that as long as inflation is over 2%, they will continue to keep rates high to ensure that inflation comes back to 2%. So given that inflation is still around 3%, we think the path of least resistance for ECB will be rate hikes to ensure there is some real rate buffer in their interest rate policy. Coming to how global bond yields reacted. So of course, given oil prices going up, given expectations of rate hike from the Fed, we saw uptick in bond yields globally, led by the US. So we saw some rise in bond yields in the US, which overall led to bond yields rising in Europe. If you see Germany rising by 35 basis, UK rising by 29 basis, Brazil, of course, 44 basis. So broadly, we saw uptick in bond yields. Japan also saw where inflation continues to be high, and market is expecting 2 to 3 rate hikes from Bank of Japan as well. We are also seeing a very heavy supply of bonds from the private sector. So usually it is said in the bond markets that it's the high spending by the public sector which crowds out private investment, which basically means that if there is a high fiscal deficit from the government and heavy duration supply from the government, it can lead to uptick in bond yields on the private side, because of course the risk-free rate goes higher, so even the private sector has to pay higher interest rate. It was the other way around in the month of July, where it is the private sector which is crowding out public borrowing because of very heavy uh, spending on by hyperscalers. It is leading to high bond supply from private sector like Microsoft, Meta, Alphabet, etc., which is leading to bond yields even on the government bond side going up, because ultimately the pool of capital is limited, and because of very heavy rates and high supply offered by the private sector, it's now in some economies the pool of capital is getting deployed there, and which is leading to lesser capital for the government bond, which is also leading to higher bond yields. Of course, during such times, India was quite resilient. So if you see, despite bond yields going up quite significantly, only China saw decline, which we talked about earlier because of overall growth slowdown. But India also remained quite resilient. It was just up 9 basis, probably as a knee-jerk reaction. If you look at, in fact, Indian bond yields, they're back to 675 now. So despite Bloomberg index not including India as part of the global aggregate index, this particular review, of course, they can include India in subsequent reviews, but despite India not getting included in the Bloomberg bond index, despite global bond yields going up by 20 to 40 basis points, Indian bond yields outperformed, given the easy domestic liquidity conditions. Market is expecting significant FCNR flows, which are also expected to go, some of them in government bonds, and that's why we saw strong support in government bonds. We'll of course subsequently discuss FCNR flows, but largely that's what helping drive bond yields down in India. And now we'll come to domestic macro trends for India. Of course, we discussed the RBI policy. Last week, we had the RBI policy where they unanimously retained the repo rate at 5/4 and maintained the neutral stance, signaling no urgency to respond to the recent rise in headline inflation. They lowered their FY27 inflation forecast by 10 basis points to 5%, and they increased the growth estimates by 10 basis points from 6.6 to 6.7%. But any major change in the current monetary policy. The current monetary policy was widely expected, where the market participants expected RBI to maintain their rates. What market participants were also expecting RBI were to probably acknowledge the inflationary pressures which are in the economy because of El Nino, as well as because of higher commodity prices. So what we saw in the US, what we saw in quite commodity prices, we saw long end bond yields getting punished in those economies. We saw some pressure on yen as well, where in fact the US Treasury had to sell their euro holdings to appreciation under check. So given these kind of global factors, it was expected by some market participants that probably RBI, if not take any rate action, but they will probably sound a little concerned on rising inflationary pressures, whether due to commodities or due to food inflation, and they will be slightly mindful, especially if you look at RBI CPI forecast, and if you look at the table on the left-hand side, if you look at the Q3 CPI forecast is 5.9, Q4 5.5, and the first quarter of FY28, that means till June of FY28, they are looking at an inflation which is higher than 5%. Their target is 4%. So given that they expect inflation to average around 5.5 for next 9 months, where the repo rate is 5/4, the market participants expected RBI to sound little concerned on inflation and probably signal some hiking at some point of time. But RBI remained quite sanguine. RBI distinguished between the first round impact of supply side shocks, whether it's oil price or food prices due to El Nino, but a more persistent generalized inflation which feeds into core inflation. So RBI kind of differentiated where that the current inflation, which is expected to move from 3.9% in the first quarter of FY27, close to 5.5% for the next 9 odd months. That is largely rising due to higher commodity prices, but they are not seeing any major impact on core inflation, and hence they are unlikely to change their stance, and they are not very concerned on high inflation, which market took it quite positively that probably RBI will not hike. We still expect RBI hiking by 50 to 75 basis later in the cycle. We do expect a pause in the near term. We think RBI is again neither hawkish or dovish. We think right now RBI, given the fluid nature of geopolitics, where oil went to 120 in May, only to come down to 70 in June, and again, there are expectations of de-escalation between US, Iran, and other economies in that region. Probably RBI wants to really wait for second round impact of this data to really assess whether how much it really needs to act to control inflation expectation, whether inflation expectations are building up in the first place. So probably it wants some impact. It wants to see the impact on core inflation. Then only probably RBI will want to take any action. So we think the bar for rate hike will remain high. So while we can't say when the RBI would like to hike, obviously it's a judgment call when they see there is a second round impact. But yes, just because the inflation is mechanically at 5 or 5.5 does not mean that RBI will want to hike or RBI will hike. Probably they will wait for core inflation also to start going up. And mind you, RBI also distinguish between core inflation and core inflation X of precious metals. We may be aware that the current core inflation also has components of gold and silver. So while the current core inflation is around 4% plus, but if you strip out the effect of gold and silver, actually core inflation X of precious metal is close to 2.5%, which is well below the target of 4% of headline CPI for RBI. So broadly, what RBI is trying to say that if you look at really core inflation and strip out the gold and silver effect, the underlying inflation in the economy is quite low, and hence they do not need to see any need of rate hike. Secondly, on the liquidity part, if we would recall in 2013 when RBI had announced TFC in our window, we saw significant flows coming in the banking system in a very short span of time, which RBI had to sterilize. So, of course, there was a concern in the market that whether RBI will currently sterilize these liquidity because of FCNR flows, which RBI clarified that they will not look to sterilize those flows of liquidity because ultimately, in every second half of the year, there is a natural currency leakage. So currency will leak out from the banking system regardless. So by March and next year, anyways, some of that liquidity will naturally go down. And hence, RBI was not very concerned about the liquidity, which gave further comfort to the market that neither RBI is looking for any rate action in the near term, neither looking for any liquidity actions. Broadly, it is quite, it bodes quite well for the bond market because both on the monetary policy and on the liquidity, RBI remains quite sanguine. And when you have a period of pause in the monetary policy coupled with easy liquidity, that always goes well for short end of the yield curve. Broadly, if you look at India's growth momentum, so this is a heat map of key economic indicators. As you can see, it shows manufacturing PMI, services PMI, industrial production, GST, bill generation, etc. And if you look at the month-on-month movement, so while manufacturing and services is slowing down, we expect geopolitical escalations to stabilize. We do expect some stability in manufacturing and services as well. But more importantly, both of them continue to remain over 50. So broadly, they continue to remain in expansion zone. If you look at industrial production, again, growing quite strong at 7%. You look at GST, EV bill generation, and that's volume and not just value, which signifies number of transactions, we can see the GST transaction will also grew by 14.5%. You look at power demand, passenger vehicle sales, two-wheeler sales, etc., all looking quite strong. And if you look at even the jobs speak index, which is a Naukri job index, that also has continued to grow. So while we saw a short blip in the month of May, where the geopolitical uncertainty was its highest, but again, job creation has started to happen as that uncertainty has reduced. So we do expect growth to remain quite strong. Even the RBI has upped its forecast from 6.6 to 6.7. Barring any major macro shock due to oil, we do expect growth to remain quite sanguine going ahead. Broadly, just looking at rainfall data as well. So, of course, in June, when the month of June ended, the whole of India was quite concerned about monsoon. We ended with the fifth driest June since 1901. So, fifth driest month in 125 years. Overall rainfall was about 40% lower than long period average. Mind you, IMD had forecasted a negative 10% than long period average, and the actual rainfall as of end of June was -40, which led to a lot of concern. Even the area under sowing was quite weak. But if you look at rainfall, it has managed to cover a lot of ground in the month of July. So from a -40%, by end of July, it was about 12.6. If you look at the current data, in fact, it's about -10%. So it's now going closer to the IMD forecast, which was made at the beginning of the monsoon period. More importantly, if you look at sowing data is quite encouraging. If you look at largely, it is just 3.6% lower compared to last year. Broadly, we do expect sowing to continue to do well. So the impact that the market participants were fearing of El Nino and lower monsoon, that impact so far has not really played out. Sowing data is quite positive. So while of course there will be some impact on sowing data given the lower rainfall, but the fear that it could remain quite low, that has not been realized. 3.5% will not materially move the inflation needle for Indian economy. What matters for inflation is something which you see on the chart on the right hand side, which shows the distribution of rainfall. So while there are areas like central India which has seen excess rainfall, or if you look at even northwest India, which has seen some deficit rainfall, but it's manageable at -11. But if you look at northeast India or east India or southern India, which are showing a -30% or a -23%, that's quite concerning, and that can lead to some spike in inflation on the regional variations. So that's something which market participants will be keenly awaiting. So while we have on an aggregate basis, monsoon is quite comfortable, we need to also see distribution of rainfall becoming more even for a more durable disinflation. So like we have been talking about in this presentation, so whether it was the oil prices which came down, but because of lower inventory, they are at risk of remaining quite stable. If you look at rainfall, so while just because things have not happened so far doesn't mean inflation cannot come up, and that explains the reaction function of whether you look at Fed or the RBI, where they are waiting for more data, they are waiting for the second round impact of these inflationary pressures on core inflation before acting prematurely. So that's the risk that whether it's the market participants or central banks, these are the risks that they are watching. And that's why we think, especially in these times when there is so much of uncertainty, but easy liquidity, that is when front to median end of the yield curve tends to do better, whereas long end tends to underperform because of all these uncertainties. Looking at FCNR flows. So of course, when the FCNR window was announced in June, there was a lot of skepticism in market whether we will get those FCNR flows given the high interest rates globally right now, whether we would get FCNR flows given there is still some taxation to be paid, whether it's Singapore or US or Europe. So how will we really get those flows, especially given that there is a geopolitical crisis going on in the Middle East? There was also expectation that probably, although tax is quite efficient in the Middle East, we may not get sufficient inflows under the FCNR route from Middle East as well. So while RBI does not disclose the geographical data, but largely all that skepticism has been unfounded. We've already received FCNR flows of about $37 billion odd. So it's very, very healthy, given that 55 to 60% of FCNR flows are expected to come in the last month. It means that FCNR flows, if they continue at the current run rate, can easily cross $80 billion. So that's something which will be quite positive for FX in the near term. Probably we will see some appreciation on the INR side in next 1-2 months, but we do expect if FCNR flows can continue to remain quite strong and somewhere can come somewhere close to $80 billion. The rest of the flows that are also expected to come are through ECB, but that we expect it to be slightly more back-ended because that ECB window runs till December. So we do expect about $15 to $20 million to come through ECB as well. So in total, all in all, we do expect $90 to $100 billion of flows through these RBI measures on ECB on FCNR, which will really improve liquidity. So if you look at the middle chart, which is the banking system liquidity and the core liquidity, while the core liquidity, which reflects basically banking system liquidity balance has gone up to more than 5 lakh crores as the end of July, which broadly means that the government has been slowing its spending because of the geopolitical volatility. And that's why your government cash balance is rising and your core liquidity is rising, but the interbank liquidity is not rising. What it really means right now is as this FCNR flows start to come more in the banking system, even the banking system liquidity will go up, which means one, CD issuance will come down because as liquidity improves, as banks get more deposits, banks don't need to issue CDs so much, and we should see some rally in the short end of the yield curve. Also, one of the reasons why this liquidity has not come is if you look at the chart on the right hand side, which talks about RBI's FX forward position. So if you look at the blue part of the chart, which showed that as at the end of May, RBI had a negative $20 billion 1 month short position. But if you look at the month of June, that 20 goes to 9. So basically, RBI gave delivery of about $11 billion. So while it got $36 billion, it also had to deliver about $11 billion in the short position. And that is why we are not seeing that much impact of liquidity on the banking system, because some of that $36 billion flows was met by outflows because of delivery of RBI forward book of about $11 billion. Also, RBI intervened in the FX market during the month of July to ensure that rupee remains quite stable. As RBI has said repeatedly, as government has said repeatedly, we are not targeting any specific level of exchange rate, but we are trying to ensure that the exchange rate remains stable. And that is what RBI is trying. So because of the intervention as well as because of FX delivery, we saw banking system liquidity which remained low. But now as the delivery has happened, the intervention has also reduced. Probably we should see more impact on the banking system liquidity in a positive manner, and we should see CD levels and also on the short-end bond levels to go down. On the trade deficit front, the trade deficit continues to remain quite elevated. If you see, it was about 28 billion in May and 30 billion in June. This was despite we were seeing, non-oil exports remaining quite strong. Largely, if you see, despite gold imports also going down, is basically the non-oil, non-gold imports which have continued to climb up. This is typically that India sees in its, whenever growth picks up, we tend to see more imports of electronics. We tend to see more imports of capital goods to support that growth. As we saw in previous high frequency indicator, we are seeing some green shoots in the growth engine for Indian economy, and that is also coinciding with higher non-oil, non-gold imports. So while yes, the story on FCNR is very, very positive, we will get $80 billion to $100 billion, but we also need to ensure is we really need to see whether this trade deficit, if it continues in the current direction, despite flows, one of the question marks which will come on the INR outlook is after this FCNR and the ECB window closes, if the trade deficit continues in this way, probably it will continue to put some pressure on currency as well. So that is something which we'll have to see, that we have to improve our export efficiency. We have to improve our logistics. So probably that's something, but that's more long term. So in the near term, it's only the oil prices which can swing the trade balance. So probably once we see again truce coming over between Iran and US, and we Strait of Hormuz opening, oil prices coming down, probably in the near term, that's what will drive trade balance rather than long term productivity growth for Indian manufacturing. So that's something which we'll have to see uh, and which will be a key determinant for INR outlook. Now, coming to credit momentum. So broadly, credit momentum continues to remain strong. We saw credit growth still at a 17.5% in July. And if you look at deposit growth, that moved from 11.5 to 12.7, also because of the FCNR based deposits. But broadly, if you look at the growth from or demand for credit, it continues to be quite broad based. So whether you look at the industry growth, which grew to 19.2%, you look at infra, which was still in double digit 11%. You look at agri growth 16%, services growth 21%. So broadly, we are seeing growth from across the sectors, which is in line with the thought. Whether we look at high frequency data, also whether we look at GST bills, whether we look at power consumption, whether we look at imports of non-oil, non-gold capital goods as well. Broadly, we are seeing strong growth, and that is keeping us quite constructive on Indian growth story, at least in the near to medium term. Broadly, the curve continues to remain steep. Like I said in one of the previous interactions, the next action whenever RBI does is expected to be a hike. So while RBI may wait for second round impact of inflation to emerge, but nevertheless, overall market expects RBI to hike at some point of time, which has continued to for the curve to remain steep. We are seeing benefit of easy liquidity and pause on rates for near term, and hence investors are happy to keep duration on the shorter end. But on the longer end, given the high geopolitical uncertainty, high global uncertainty, as well as expectations of rate hike, that's where it's leading to underperformance of the long end of the yield curve. Broadly, if you look at curve movement and credit spreads, what we saw was some uptick in the bond yields due to the higher oil prices in the month of July. So for example, if you look at 3-year AAA, it moved from 7.18 to 7.38. You look at 5-year also, again moved from 7.23 to 7.38. Whether you look at government bonds or AA as well, they all moved up by 5 to 10 basis, largely due to the oil price. And as now oil price comes back, as there is a truce expected between US and Iran, probably we'll see bond yields going back to their historical levels. So broadly on the outlook, like I mentioned, that RBI is likely to remain on an extended pause. While we do expect a rate hike of 50 to 75 basis in this monetary policy cycle, the bar for rate hike is quite high. RBI thinks that the current inflation is largely supply side, and unless and until they see inflation percolating in core inflation, X of precious metals, which is basically right now running at 2%, going to at least close to 3.5%, that is when RBI will start to probably get worried about inflation. That will be one area where they can start thinking of rate hikes. But more important is any market reaction is a function of actual happenings versus market expectations. Largely, if you see the bond market, it's already pricing in about 60 basis of rate hikes. So even if there is some 50 to 75 basis of rate hike, largely it's priced in by the short end of the yield curve. On top of it, like we discussed, we are seeing very active participation in the FCNR flows. We are likely to see FCNR flows between 80 to $100 billion. We are likely to see ECB flows coming in about 15 to $20 billion. So broad $100 billion of flows coming in. Even if you remove the 40 billion which has come so far, we are expecting 50 to 60 billion dollar of further flows coming into the banking system, which should keep the short end relatively well anchored. So broadly, we do expect Given RBI patience and comfortable liquidity, we do expect the 1 to 3 year part of the curve outperforming compared to the long end, which is still subject to global, yield sensitivity or currency volatility due to geopolitics. So broadly, we do prefer 1 to 3 year part of the curve. Of course, investors who are looking at 3 to 12 months investment horizon can consider money market or low duration strategy. Investors who are looking at 12 months investment horizon but below 2 years can consider short term or corporate bond. And investors who are considering for more than 2 years can consider income plus arbitrage funds for tax efficient returns. So I'll stop here and we'll open the floor for Q&A. Thanks a lot for listening in.
Sure. Thank you, Anurag, for sharing your perspectives. So now let's move to the Q&A session. Let me start with the first question. So in the latest policy of Reserve Bank of India, it emphasized the need to look beyond the headline inflation number and focus on its composition before taking any policy action. What message do you think this sends to the bond market?
I think what the RBI was trying to say was trying to reconcile its inflation forecast with its monetary policy. So if you look at RBI's inflation forecast, like we discussed, it is even going as far as June of FY 28 or calendar year 2027 June. It's expecting inflation to average around 5.3%. So when you're expecting inflation of 5.3% and your repo rate is 5.25, that's something, a disconnect somewhere. And that is what it is. It was trying to explain to the bond market that while inflation will be over 4%, which is the RBI target, and it will be higher than RBI's own policy rate of 5.25, why RBI is not looking to hike rates or to sterilize liquidity when liquidity comes back due to FCNR flows is because it views this inflation as supply side led rather than demand side led. So and given that inflation is supply side led, it's largely one off. And unless and until they see that, okay, this inflation is not one off, it's not affecting core inflation, it's not leading to generalized price pressures, they do not see any reason to hike interest rates because that largely will even out. Just to give an example, last year, inflation averaged around 2% because of lower food inflation. They did not cut rates just because inflation was 2%. Similarly, they don't want to hike rates just because inflation goes to 5% due to higher food prices. So they want to see whether that inflation is more durable, whether that inflation is moving into core. And only once they are certain, that is when they are likely to hike rates. So they wanted to explain the divergence between their inflation forecast and their muted reaction on the monetary policy. And that's something which I think they were able to successfully tell the bond market, because the bond market, of course, rallied after the policy, and that's something. So that shows of effective communication of their intent.
So the next question is, the recent deferment of India's inclusion in Bloomberg's Global Aggregate Bond Index has raised question around the timing of foreign inflows. Now, beyond the near-term impact, does this change the medium-term investment case for Indian government bonds in any meaningful way?
So we think that, like Bloomberg also mentioned, that they have deferred the inclusion due to some operational parameters, and they want to see stability in operational parameters for a long period of time before adding India. But if you really look at FPI flows in Indian bonds, they have been in excess of $6 billion since June. Of course, some of it was in anticipation of Bloomberg index inclusion. But if you look at the deferment, even after deferment, we have not seen any outflows, FPI outflows from the bond market, despite oil prices going up, despite the index inclusion not happening, which broadly means that if you really look at Indian bonds or Indian fixed income, it's really come a long way, and it is holding on its own despite global bond yields going up. We saw in previous table that everywhere across the world, except probably China, which is facing slowdown, we saw bond yields are going between 20 to 40 basis. But despite that, Indian bond yields, despite the deferment of inclusion in the Bloomberg index, were quite stable, because overall the bond market believes that yes, there is no long-lasting or durable inflation in India. It's still supply side led. Overall, if you look at the fiscal deficit, that while on the margin it's slightly negative because of the oil price related subsidies, but overall it remains well controlled, especially compared to rest of the world. And growth continues to be quite decent. Ultimately, any bond investor also looks at debt to GDP trajectory of any economy, and if the GDP growth continues to do well, uh, there is a broad-based expectation that the debt to GDP will also come down subsequently. So that's something which where India has been demonstrating, and that's something where we think that the medium to long-term story for Indian fixed income is quite intact, and it's a matter of time whether India becomes part of the bond index. But ultimately, if you look at foreign holding in Indian bonds, it's less than 4%. So it's not that the foreigners' participation in Indian bonds is really driving bond market. While of course, index inclusion always helps. You get diverse set of investors, but it's not that something the bond market is hostage to foreign investments.
Thank you. The next question is, global bond markets are increasingly being influenced by higher sovereign borrowing and rising developed market yields, particularly in US and Japan. Now, how relevant are these developments for Indian bond markets today?
Sorry, which borrowings did you mention? Higher.
Sovereign borrowing and the rising developed market yields, particularly in US and Japan. Now, how
Sorry,
relevant?
your voice was not clear. Which borrowings?
Okay, I'll repeat the question once again. Now, global bond markets are increasingly being influenced by the higher sovereign borrowing and rising developed market yields, particularly in US and Japan. Now, how relevant are these developments for the Indian bond markets today?
So I think what we have established in last 5 years as global bond yields on the sovereign side have been quite high. So it's not just for the US and Japan. Of course, they are in the news recently, but whether you look at Europe, you look at Germany, you look at UK, I mean, we have in fact talked about it in one of our previous webinars where when the world ended COVID, uh, about more than $6 trillion of bonds were yielding zero or negative bond yields. And of course, now there is none. And during all that transition, Indian bond yields or many other emerging market bond yields have been quite stable. So I think that lens of looking at all emerging market bond yields through the lens of US has gone away because and we have in fact talked about this earlier as well that before or 5 years prior, US used to run a 3% fiscal deficit. Now it runs a 6% fiscal deficit. Same way for many economies where they have not been able to really bring down their fiscal deficits post-COVID. So today, bond investors discern between the local issues and global issues. They are able to see where secular bond yields are, where local bond yields are supposed to be. So I don't think whether, I mean, of course, if global bond yields remain volatile, INR remains volatile, does it mean it will not have any impact on Indian bond market? It will have an impact, but probably the degree of the impact will be much lower. And ultimately today, most of the emerging markets are driven by their local factors. So whether it's India, Indonesia, South Africa, Brazil, anyone, most of them are driven by their local factors rather than, just because US is moving in one way or the other.
Interesting. Okay. So the next question is, the ownership profile of India's government bond markets has been evolved significantly over the years. Now, has this changed the way the bond market responds to macroeconomic developments compared to the previous cycles which we have seen?
So largely, I would say I would differ. So I don't think bond market foreign participation of or the foreign ownership of Indian government bond market has really evolved. It's largely been below, like I said in the previous question, it's below 5%. So it's not that the foreign ownership of Indian bonds is really high. I think what does, the inclusion of India in JP Morgan bond index did help dispel one myth. It was always expected that the bond markets tend to be quite fickle. They tend to be quite short term in nature, and they can go in and out very easily. And that's why, I mean, there were limits to the bond market opening that we saw in India. But as the last two years have shown us, it's actually the FPI outflows in equity which have happened. The bond market has remained stable. So I think that's one thing which has demonstrated, while the ownership continues to be low, but it shows that it's not that the bond market investors, even despite foreigners, are fickle and short-term in nature. It totally depends on the macro dynamics, and if macro dynamics for India are not bond negative, and that's why we are seeing flows remaining quite stable while they have not picked up, because of course we are not in a rate cut cycle, but they have remained quite stable.
So, in the interest of time, I'll take one last question. Markets today appear to be balancing several moving parts, from geopolitical developments and commodity prices to global monetary policy and domestic macro data. If you had to identify one risk or opportunity that you believe the bond market is currently underappreciating, what would that be?
I think in the near term, probably FCNR flows. I think once, like I said, because the liquidity situation has not really changed because of RBI FX delivery as well as intervention, probably the scope of FCNR flows and the potential of FCNR flows especially on the near term of the bond market, have not really been impacted and not really been there. But I think in the near term, at least, that can have a meaningful impact. As far as the moving parts, whether it's a global bond yields, domestic macro factors, geopolitics, there will always be moving parts in market. Labels will change, things will change, but there will always be moving parts. To say that there will never be a moving part, that will never happen. So that will keep on happening. One has to, like I said in the beginning of the webinar, there will always be some headlines. What we as investors have to see what's durable for the market or the asset class that we are investing in. What is the best case scenarios or the scenarios that you can envisage, and what is the most likely scenario that you think will play out. So yeah, and I think the likely scenario which can play out potentially is the FCNR flows, because there we are actually seeing good run rate, and given by historical precedents, given that 50-60% of flows come in the last month, it's quite, we are quite comfortable expecting a $80 billion odd FCNR flows itself, apart from ECB. That's one thing I think markets probably underappreciate.
Thank you, Anurag, for answering all the questions, and thank you, participants, for joining us today and sending your thoughtful questions. We hope today's discussion has provided useful insights into the evolving macro environment and the outlook for fixed income markets. We look forward to welcoming you again in our next edition of UTI Mutual Fund's Fixed Income Market Insight webinar. Thank you and have a great day ahead.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.